Welcome to Market Guru. Joining us on the show, Ritu Arora, Chief Investment Officer at Canara HSBC OBC Life Insurance. Ritu, good morning. Markets have been fairly volatile this last week on the back of concerns with regards to that Fed rate hike. So let me jump in on the deep end here and first ask you what you feel about that, and whether or not the probability is high. And the bigger question is, how much of it do you really see affecting us?
Thanks for having me on the show. Clearly, it is a concern which is spooking the global markets and not just Indian markets. It is a very real worry. And last time we saw, last December, when Fed had increased rates, we saw a huge amount of volatility, outflow of funds in our equity markets. Currencies across the globe were impacted. And even in past, whenever Fed has tightened, and I'm going way back, when we look at the Mexican peso crisis or the Thai crisis, Thailand crisis, that balance of payments and currency crisis. So Fed tightening does have an impact on the world and global economics, and one cannot undermine its importance. I guess in current situation, it is a matter of when and it's not if. And I guess that is what the market is getting prepared for and discounting. It could be September, it could be December, but it looks imminent given the improvement in economic data of USA that it's more likely to happen sooner rather than later. And the concerns will prevail, and I would expect volatility to reign supreme over all the markets.
Good morning, Ritu. I wanted to first start out by taking your views on longer term investing. Because while all funds suggest everybody to invest long term, we know what the challenges of trying to invest for 20, 30 years is, because many wars happen, countries change, boundaries change, so it's a very different, but you luckily have that background because you've got to manage money actuarially for 20, 30 years. So, and you have to kill a lot of noise. So I wanted to take two sectors, if you can just kill the noise that's going on right now. And I'm just wondering if these two sectors are the new world's commodities, which is telecom and power. And maybe in 10, 15-year investing, we're talking about 3 or 4 guys who can supply you this commodity, and billions of people who are helpless without these two commodities. If we look at the market that way, then some of these stocks have a totally different view as compared to when you view it just in the short term. Just your thoughts, Ritu, because while we talk about power consumption in India, I often bring that example that in California 50% power is just used by Google servers. So we're not even at the tip of the iceberg, and the number of suppliers both in telecom and power are actually very limited.
A very interesting question, and will deserve a longer answer. We as insurance are definitely long-term investors, and when we look at our fund performance, we are very proud of the fact that over the last 8 years that we've been in existence, we have consistently outperformed the benchmark across all time frames and stacked very high in peer ranking in the top quartile. But that is not achieved by passive management. So that is where I will distinguish between long-term investing and passive investing. Long-term investing is not passive investment. One is always actively looking at how the economies are playing out, how sectors are moving, and how stocks within that are moving. And definitely there is realignment of portfolio on a very regular basis. And hence telecom or power or any other sector for that matter over 15 years goes through its complete cycles, up, downs, there are news, there are new entrants, there's disruption, and all of that has to be taken into play when a portfolio is constructed. Specifically on these two sectors, definitely we have a long way to go. The potential as well as demand is pretty huge. Telecom, of course, the penetration is extremely high and one of the best globally. But in terms of power, of course, we have a long journey to cover. And but the sector was plagued by shortages, as we all know, on challenges on distribution, shortages on raw material, coal challenges, etc. And one cannot forget those when we are building the portfolio. So these are very important sectors, but for now, not sectors that I would add weight in.
Okay. Ritu, what are your thoughts on the banking and financial space at the moment, given the kind of measures we've seen from the SEBI, RBI, to kind of open up the sector and mend some of those NPA issues? we've seen a lot of action as well, of course, on the NBFC front. How are you looking at the overall space? What are some of the trends you see emerging there? Okay, let me check if we've got that line to Ritu fixed. I think we have a slight technical issue coming in there. But in fact, Ritu has in the past spoken about how perhaps the worst could be past us for some of those PSUs. But I'm interested in just getting a sense from her on where she stands now with regards to PSUs. Private banks, of course, seem to be on everyone's radar at this point of time as well. So we'll get a check from her on that. In the meantime, of course, today banks are back in action and we are seeing that uptick in trade. So Bank of Baroda, Yes Bank, SBI, ICICI, Axis, everything seems to be on the move, and healthy gains now as well coming in. Actually, the index is also now up about 0.2%. I think what's keeping it, however, from moving higher are some of the names on the downside: ITC, HDFC, Coal India, Tata Steel. So that's considerable pressure. Tata Motors also down about 0.5% today. Okay, I think Ritu's back with us. Ritu, I wanted to get your view on the banking and financial space and how you're maneuvering through that at the moment. I think last time we spoke, you did say that the worst could possibly be behind us for PSU banks. Are they now on your radar? Would your preference still be on the private space?
PSU banks have started showing, at least some large ones have started showing signs of repair, stability, and the worst being behind them. But a large number of them are still struggling with the challenges, deteriorating asset quality, NPA, etc. So one needs to be very discerning when one makes investments in these banks. Banks definitely as a sector demonstrate the movement of the economy, the other side of the coin of the economy, and hence banking is, and it represents almost a third of the index weight as well in large caps. So it is important to do a bottom-up stock selection, and clearly private sector banks, because of their fundamentals, tend to be better placed and find a place in the portfolio as well. But one cannot ignore public sector, and one will have to see the turnaround stories and include in the portfolio, because that is where the multiples are still very low and money can be made.
Ritu, once again my question goes back to long-term investing, and I'll break it up into two parts where you have to focus on the management and one you have to focus on the events. So I want to start up with events and just walk you back about 20 years. In 20 years we've had Iran and Iraq wars, we have Gaddafi gone, Saddam turned from ally to enemy, Afghanistan got bombed God knows how many times, there was Taliban, ISIS, Google came to 10 years ago, and of course the internet is only 25 years. I mean, when I look at going back, it's just mind-numbing the kind of job you have looking 25 years ahead. And in an environment of complete causal opacity, if I may use that word, in such an environment, where do you see and what do you see as the investment themes that may emerge that may be a little immune to events?
So that is where I'll come back. So it is not, no one can foresee what will happen in 25 years and what the world will look like in 25 years, what the geographical, political, economic distribution will be like. So it is very difficult to look at 25 years, but it is definitely possible to look at next 1 year, 3 years, 5 years, and with reducing certainty as the time frame increases. And that is what we try to do. So I cannot do a stock pick with 25 years in mind, but what I will do is hold it for 25 years if what I'm expecting on the management in terms of stock performance continues to play out. So when we do stock selection as long-term investors, we will look at management. Management is a very important aspect of how the stock and the company performs, the quality, the governance around it, and of course the results and the business plan, the strategy that they have. So that is what drives the portfolio construct, and we will keep realigning it every time there is a pertinent bit of news, be it economic, global, fundamental to the company, or a difference in the results. So companies that have been doing well actually don't perform so well in a changed economic scenario and will need to move out of the portfolio at the right time. So I agree with you, 25 years is definitely mind-numbing and not possible. But as long as you consistently over those 25 years evaluate the portfolio on the same fundamental framework, and we look very closely at price to book, price to earning, management quality, the stock price movement, and if you consistently follow the metrics and the strategy, that is what gets superior returns, and not necessarily holding the same stock for 25 years.
Okay. Right. Ritu, I know we've been asking you some fairly convoluted questions this morning, but here's another one. There's bound to be some convergence between sort of what we're seeing in banking, telecom, and IT, new payment interfaces, fintech, of course, smartphones becoming a banking channel. Is there any kind of proxy way in which you're looking at investing in companies with an eye on how some of these trends will shape up in the future?
Most definitely we have been, and we've been quite successfully doing that. If you looked at our portfolio, that has worked quite well for us. So fintech, banking, new age banking, digital is all spaces that we are very closely looking at. Not so many listed plays available there, which is a limitation at this point in time, but quite interesting disruptions on the anvil, and one should look at those. Those are smaller companies, but very exciting spaces to invest in.
Ritu, there was another thought while you were talking about long-term investing, and you talked about having a framework. So this is partly on a lighter note, but it's also partly on a serious note. How do I keep a longer-term framework, Ritu, when fund managers start out as analysts, then they get promoted as fund managers, they get transferred, somebody else puts another fund manager there, ownership of the insurance company goes from one hand to the other. So there is no consistency of thought process. I'm speaking the truth to you because, instead of looking at funds, I've tried to go around looking for fund managers, and I'm completely shocked. The guys move from fixed income to equities to something else, and then something to... How do I then take a longer term perspective, and how can I be sure my actuarial money is actually protected? And I've actually lost money because an insurance company in Canada went bankrupt on a guaranteed insurance scheme. So it happens. And I just wanted to ask you, how should investors then really think long term when even the guys managing the money are not the same?
It is hence, like I said, for companies, likewise for making your investments, it's extremely important that you select the right management. People will change for multiple reasons. That will happen. Usually organizations subscribe to frameworks, and when you look at larger, more respected ones, not fly-by-night operators, you will find them saying a consistent story, even if the fund managers have changed on the way that the money is managed. I'm a part of a very large financial group, and I know how consistently these frameworks are followed irrespective of individuals, because individuals have to be dispensable in any system. When any system becomes too dependent on one individual, I feel that is in fact a bigger risk than having people changing but the framework sustaining. And hence, when you look at investment performance, please do not look at 3 months, 6 months, 9 months. Please look at least 5 years, 3 years, 2 years, and 1 year is relevant, but I would give more importance to the longer term, and more importantly how consistent it has been. So look at the volatility of that performance. You will find, especially in mutual fund, huge volatility. There are funds which are in rank 1 for a period and then they slip to the bottom. Likewise in insurance, please go with the right managements. Unit linked is not the only product that insurance offers. There's a whole range of traditional products, universal life products, participating products, non-participating products, and hence as per one's own risk appetite one should choose. And I don't think the story which you shared of Canada would repeat in India, because the regulator has been very astute and very conservative in terms. Though we've seen insurance companies change hands, you've not had a single instance ever of any claim not being honored because of reasons of consolidations or mergers, etc. So the capital set aside to meet liabilities is done very prudently in India. So hopefully you will never have such a situation ever playing out. But when you select from investment perspective, please look at the management and framework and what has the management been consistently delivering and consistently saying.
Ritu, now I wanted to come to the banks, and I want to break the banks into 3 different groups. We'll take a longer term, I won't call it very long term, but long term perspective. Public sector banks, private sector banks that were basically in a rent-seeking environment because nobody used to get licenses, and the new banks. And, if you look at it immediately, you will say, well, the razzle and dazzle of the new banks is going to pull customers away from government banks, and all kinds of conversations happen. But when I look at them, I start wondering how crowded these trades are. Because just about every institutional investor was using 4 or 5 private sector banks to play India. And of course, now you have a choice of 70 banks. And now I wanted to come to the government banks. I personally have always felt you never ever challenge the sovereign. If the sovereign decides that all government salaries will go into a government bank, that's what will happen. If they decide transactions will only happen with a government bank, that's what will happen. Are we writing off public sector banks very quickly? Because they are, at the end of the day, the sovereign's banks. And the sovereign makes the rules of the game we all play in.
Absolutely not. I don't think I have ever mentioned, and I haven't heard many of my peers talk of writing off a public sector bank. Public sector banks are extremely strong. They truly represent our economy. Private sector banks, still most of them do not have the depth, reach, penetration that public sector banks have. The kind of corporate lending that public sector banks do, private sector banks do not always have the flexibility, courage, credit appetite, whatever you may want to call it, to do. So clearly public sector banks are the pillars of the economy, and one cannot undermine their importance. What has definitely happened for them is, in the economic down cycle, they have faced a lot of pressure on the asset quality and non-performing assets. They've been write-offs, and that is plaguing the balance sheet at this point in time, and hence they were not the favorites of the market. But I would, and we have made very good investments by doing the right selection of public sector banks. So each bank, I think India, with such an underpenetrated banking system, financial inclusion numbers are so low that there is place for all of these, and that is what RBI has been saying, that all these banks, including payment banks, niche banks, microfinance organizations, each one has their own role to play and a niche and a corner for themselves, and one needs to evaluate each on their own merits. And I would be very aghast if any portfolio did not have a representation from all these sections of banking, non-banking financial companies, microfinance companies. So all of these do find place in the portfolios. They definitely do in my portfolio, and I wouldn't undermine the importance of any one vis-a-vis the other.
Okay. Ritu, how closely are you also watching out for the earnings revival? We had the latest IIP figures out. We're not seeing any kind of uptick on the manufacturing side. What will you be looking for when it comes to the next quarter?
Definitely, I think earnings is the next biggest thing to look out for in Indian economy. Of course, the global volatility will have its share in the way the market performs. But in terms of fundamentals, for me, it is going to be the earnings season. The current earnings season was pretty much in line, but not very exciting. We need to see an earning uptick to say that the worst is behind for the economy, and we will continue to shine in the global turmoil. If we do not see the grassroots green shoots of economy converting into corporate earnings, they might just wither away and die. So for me, the next 2 corporate earnings are going to be extremely crucial to say that we've turned the corner and Indian economy is out of the woods, and we'll from here see positive momentum and growth.
So Ritu, I was looking at the market caps of around 5 or 6 non-banking financial companies. And if I had, let's say, 100% of that stock and I sold it, I could have bought 5 PSU banks. And I'm just wondering, in a country where an FIR in some small corner can put the promoters away, really, market cap of a non-banking financial company is 5 times a bank owned by the sovereign. Somewhere it's Alice in Wonderland. I'm not sure which one is it. So I'm just wondering if portfolios need to be reshuffled. Nobody's saying don't enjoy the party. But I'm saying the strings are with the sovereign, right? They just need to play it once. The game's over. And some of these guys are lending to the lowest common denominator, which means if there's a political backlash of lending at high rates and earning big spreads, they're going to get to you first. They're not going to go after the people. Just some thoughts, Ritu, and what your thoughts are about this whole belief that NBFCs are going to take over from PSUs.
I would again go back, rather than paint everyone in the same brush, I would encourage you to discern between them, and I wouldn't do it out of fear of big daddy or sovereign. I would do it more basis the strength of the balance sheets, the size of the balance sheets, the way they have been managed. So there could be public sector banks which have not been managed very well. At the same time, they can be microfinance companies or NBFCs which have been managed extremely well and have been consistently showing improvement in their performance. So while we should have a view on the sector as a whole, be it public sector banks, so this, the view on public sector banks would be this is where money is to be made, but move with caution, do the right stock selection. In case of NBFCs, we all know we saw a huge rally, and so in that rally, mid and small caps outperformed, and almost all NBFCs had a very stupendous market returns to demonstrate. But from long-term investment, it is very important to discern the good from the not the average, and that is how money is to be made, rather than worry about the fact that because public sector banks have sovereign backing, they will use any rule change to outperform. I think India is far away from that regime when the rules were changed or sovereign muscle was used to determine the position of a market player. We are in a very fair, transparent, equal ground, fair play ground, and each one will perform as per their own business models and merits and management quality and governance and the business strategy that they have. And for us, hence, bottom-up stock picking is extremely important, and more so in sectors like NBFC, where it is very important to distinguish between the ones that will survive and the ones who after the meteoric rise may not be able to sustain. So that is how we approach these sectors, for that matter all sectors.
Okay, so then Ritu, if we're to finally, just to sum up, stack your portfolio on the overweights and underweights, would it be fair to say that you're bullish perhaps on banking and the domestic growth stories, and underweight clearly on metals, even IT, pharma at this point?
That's right. I'm very bullish about the domestic India story. I believe that we are an isolated island of calm, of progress. And so I'm very bullish on Indian demographics, Indian recovery, Indian growth. And I'm underweight everything that is overseas, exports, so IT, pharma, other sectors, allied sectors fall in that. So I definitely want to play India theme for now.
Ritu, just one last question I had. You said there's very fair competition, level playing field. That's great for consumers. But as a shareholder, I like cartelization. US banking history is filled up with examples where the US government allowed one or two banks to go ahead and issue Brady bonds and all kinds of emerging market bonds. Histories of many other 100-year-old banks are backed by colonial backup as financiers of the colonial regimes. So actually, as a shareholder, I don't mind if some banks get special privileges, but what you're saying then is that all these banks have turned into commodities because the government's not going to give any preference. I'm feeling bad as a shareholder.
It's an interesting perspective to have. But I believe that one cannot build a portfolio based on, in fact, such protections, because that can change with the regime. It can change with the change of mind of a minister. So that is not really how I would build a portfolio.
All right, Ritu, we'll leave it there. Thanks so much for joining us this morning. That's all from us on Market Guru. Stay tuned.